How do you destroy a ghost? How do you cage a man whose entire empire is built on smoke and mirrors, who moves millions without touching a single bill, whose power lies not in violence, but in the pristine, untraceable flow of numbers? In the 1950s, the FBI faced this very phantom, Meyer Lansky, the quiet, brilliant architect of organized crime's finances. They knew he was the engine, but they couldn't find the chassis. They knew he was guilty, but his books were cleaner than a Swiss hospital. In a final, desperate gamble, they launched Operation Safecracker, a nationwide financial blitz. They seized not one, not 10, but 100 of Meyer Lansky's suspected bank accounts, from Miami to Zurich, sifting through a tsunami of transactions, looking for the one fatal flaw in his perfect system. They believed in volume, that with enough force, the truth would crack. But Meyer Lansky didn't build his empire on force. He built it on precision. In a mountain of 100 ledgers, in a river of 10,000 transactions, there was only one, a single, seemingly insignificant financial tremor that held the key. One transaction, buried in a sea of noise, that the FBI's accountants almost missed. What was that transaction? And how could one tiny slip in a lifetime of perfect calculations finally doom the man they called the mob's accountant? To understand the way of this hunt, you must first understand the prey. Meyer Lansky was not a gangster in the traditional sense. He was the CEO of the underworld. A diminutive, soft-spoken man with the mind of a mathematical prodigy, Lansky had transformed the mob's cash-based, chaotic rackets into a sophisticated, multinational corporation. He was a partner of Lucky Luciano, the financial brain behind the commission, and the visionary who turned Havana into a mob paradise. By the mid-20th century, while flashier bosses went to prison or the grave, Lansky thrived in the shadows. His power was his invisibility. He didn't own flashy casinos on paper. He owned the holding companies that owned the banks that financed them. He laundered money through layers of legitimate businesses, from jukeboxes to laundromats to Swiss trusts. To the FBI, led by the relentless J. Edgar Hoover, Lansky was the ultimate prize. But he was also the ultimate puzzle. They couldn't get him for murder, extortion, or bootlegging. The only possible charge was tax evasion. And to prove that, they needed to trace illegal income to him personally, a task akin to finding a specific drop of water in the ocean after it had evaporated. The conflict, therefore, was a silent, sprawling paper war. It was a battle fought not in back alleys, but in sterile government offices and backrooms of offshore banks. The FBI's brain squad, a team of forensic accountants, was pitted against Lansky's labyrinthine financial architecture. They subpoenaed records, followed wire transfers that disappeared into Caribbean shells, and hit constant dead ends. Lansky's system was designed with redundancy and misdirection. For every account they froze, they suspected 10 more existed. The sheer volume was the weapon, drowning the investigators in data. The breakthrough didn't come from a smoking gun, but from a subtle anomaly. Amidst 100 seized accounts, one, held under a benign-sounding corporate alias in a Miami bank, showed a pattern. It wasn't a massive deposit. Lansky was too smart for that. It was a series of modest, regular outflows. Payments. But one payment was different. It wasn't to a known shell company or a business front. It was a single lump sum transfer to a numbered account in a Liechtenstein bank, a bank famed for its ironclad secrecy. This transaction itself wasn't illegal, but the timing and the recipient were the clues. Cross-referencing this with painstakingly gathered intelligence from informants and wiretaps, the FBI agent on the case made a connection. The Liechtenstein account was linked to a silent partner in one of Lansky's flagship Cuban casinos, a partner who was, in fact, a front for Lansky's own reinvestment of skim profits. This one transaction was the thread. It connected a legally seized domestic account, the alias, to a secret foreign account, the recipient, which was linked to an illegal, untaxed profit stream, the casino skim. It was a proverbial needle in the haystack, the single point where Lansky's desire to move money efficiently briefly overrode his instinct for total obscurity. It was a tiny crack in a flawless wall. This single transaction didn't contain the crime, but it provided the map. It gave the FBI the legal precedent and the probable cause to pressure European authorities, to peel back another layer and then another. It was the first domino. The consequences were slow, seismic, and deeply personal for Lansky. That one transaction doomed the strategy of perfect secrecy he had lived by. It opened a pipeline of information that the FBI used to build an incontrovertible tax evasion case. While he ultimately avoided a long prison sentence through legal wrangling and his failing health, the true consequence was the dismantling of his invincibility. The U.S. government, using this case as a blueprint, began systematically closing the loopholes he exploited. The pressure forced him into exile, first to Israel and then, after a bitter deportation battle, back to Miami where he was a watchman. His fortune, once fluid and global, became frozen and defensive. The man who controlled money flows across continents spent his final years fending off the IRS over personal back taxes. The myth of the untouchable financial wizard was shattered. The legacy of that one transaction is a parable for the modern age of financial crime. It proves that no system, no matter how brilliantly designed, is immune to a single point of failure. Meyer Lansky's error wasn't greed or violence. It was an infinitesimal lapse in operational security, a moment where complexity created a tiny, fatal vulnerability. For law enforcement, the lesson was to abandon the hope of seeing the whole picture and instead hunt for the anomalous pixel, the one data point that doesn't fit the perfect pattern. Today, this is the foundation of all anti-money laundering and forensic accounting. Algorithms flagging unusual transactions. Lansky's life and near downfall teach us that in a world increasingly made of information, power belongs not only to those who create the most complex systems, but also to those who develop the patience and insight to find the one fragile link that holds it all together. He was doomed not by a grand betrayal or a bloody war, but by a decimal point in the wrong place, a transfer just a little too clever, in a sea of 100 perfect ones. His ultimate legacy is a haunting reminder that in the digital ledger of life, everyone, even a ghost, eventually leaves a footprint. That footprint, however, was not a clumsy mark in mud. It was a microscopic fracture in a diamond-hard facade, visible only when light hit it at precisely the right angle. The FBI agent who spotted it was not a traditional G-man, but a new breed of warrior, a financial archaeologist. His weapon was not a pistol, but a magnifying glass held over miles of ticker tape and ledger lines. His victory was not an arrest, but a connection. This shift, from chasing gangsters to chasing their financial shadows, marked the true death knell for the old-school mob and the birth of the modern, bureaucratic war on crime. For Lansky, the consequence of that one transaction was a life lived in a shrinking world. Each subsequent legal move by the government, empowered by that initial thread, was like a lab technician applying a solvent to an ancient palimpsest, slowly making the hidden writing of his empire visible. His network of trusts and shells didn't vanish, but it lost its liquidity and, therefore, its power. Money that cannot move is not capital. It is a relic. He became a curator of his own frozen fortune, a king ruling over a glacier, watching it melt slowly in the sun of relentless scrutiny. The psychological consequence was perhaps the deepest cut. Lansky's entire identity was built on being the smartest man in the room, the one who saw the matrix of money, while others saw only cash. The revelation that his system had a flaw, however minute, attacked the core of his self-mythology. It introduced a seed of doubt into a mind that operated on absolute certainty. Every future transaction, no matter how small, would now carry the ghost of that one fatal transfer. His genius had been infected by a meme of error. The legacy of this event is the cornerstone of the entire surveillance capital state. Lansky's predicament taught governments that sovereignty in the 20th century would be defined not by borders alone, but by control over financial channels. The laws that sprang from his case, Bank Secrecy Acts, requirements for currency transaction reports, created the paper trail that now ensnares everyone from corrupt politicians to terrorist financiers. He is the patient zero for the disease of financial transparency that now infects every shadow economy. But there's a darker, more ironic legacy. In trying to build a perfect, invisible machine, Lansky accidentally authored the manual for his own kind of destruction. His methods became the textbook study for both criminals and cops. Today's crypto-anarchists and ransomware gangs are his direct descendants, attempting to build new digital labyrinths. And the Chainalysis detectives tracking them are the direct descendants of that FBI accountant, still looking for the one anomalous transaction in a blockchain instead of a ledger. The final, profound lesson is about the tyranny of perfection. Lansky's system was so good, so seamless, that it could only fail from within. The pressure to maintain flawless, complex secrecy across decades and continents created an internal stress point. The one transaction that doomed him was likely the result of forced error, a need to quickly solve a problem, placate a partner, or capitalize on an opportunity that momentarily overrode the sacred protocol of obfuscation. In the end, Meyer Lansky was not defeated by the FBI's might, but by the inherent impossibility of his own ambition to exist as a pure, frictionless force within a corrupt and granular world. The single transaction was the universe's receipt, proving that even a ghost must occasionally touch the ground, and in that touch leave the evidence of its own existence. That evidence, however, was not merely a datum. It was a philosophical correction. Lansky had sought to achieve a form of economic anti-gravity, to create value that obeyed only his own logic, untethered from the massive legal and social consequence. The single doomed transaction was the moment gravity reasserted itself. It proved that his capital, no matter how brilliantly abstracted, was never truly liquid in the metaphysical sense. It always retained the viscosity of its origins. Each dollar carried the faint, indelible stain of the gamble, the vice, or the coercion that created it, and the system designed to bleach that stain had a limit. The FBI's triumph, therefore, was not in outsmarting Lansky, but in patiently waiting for the inherent tension in his design, the conflict between infinite ambition and finite operational precision, to produce a detectable tremor. They won by understanding his philosophy better than he understood his own limitations. For Lansky, the aftermath was a living autopsy. Every legal hearing, every frozen asset, was a dissection of his life's work. He was forced to watch as the elegant private syntax of his ledgers was translated into the crude, public language of indictments and tax liens. His genius was reduced to a series of exhibits. This process neutered his power more completely than any prison sentence could. A jailed gangster remains a symbol. A financially exposed one becomes a case study, a precedent that empowers his enemies forever. His exile was not just geographical, but existential. He was pushed to the periphery of the very system he helped define. The new generation of operatives, both criminal and federal, now studied his methods not with awe, but with clinical detachment, learning what to emulate and, crucially, what to avoid. The single transaction thus became a causal nexus in history. It directly led to the militarization of financial regulation. Agencies like the IRS Criminal Investigation Division and FinCEN grew teeth because of Lansky. He demonstrated that the gravest threats to the state were no longer ideological armies, but silent, solvent networks. In doing so, he triggered the creation of the very surveillance apparatus that would make his own operational model obsolete. He was the catalyst for his own paradigm's extinction. His legacy is thus a paradox. He is the godfather of modern money laundering and, simultaneously, the reason it is so perilous to tempt. The Lansky lesson is etched into the code of every compliance algorithm. Perfection is suspicious. True anonymity is a statistical impossibility in a monitored system. The hunt is no longer for the criminal, but for the pattern that seeks to be invisible. Ultimately, Lansky's story transcends crime. It is a cautionary tale about the architecture of power in the information age. He believed that in a world of symbols, money, contracts, shell companies, a master of symbols could become untouchable. He failed to account for the material substrate, the human need to communicate, to trust, to make a mistake, to leave a record. The single transaction was a backdoor left in the software of his empire, not by a hacker, but by the inherent bug of human agency. His ghost still walks the corridors of global finance, not as a specter to be feared, but as a foundational error in the code, a reminder that any system built by humans, no matter how brilliantly conceived, contains within it the seed of a single catastrophic and ultimately illuminating flaw.